Tax accountants versus financial advisors. This is Brad with Premier Tax CPAs. The best way is to have them both work together. Many taxpayers have a financial advisor and a tax accountant, but not a lot of people coordinate the efforts between the two professionals, and that's not ideal. You probably want to go to a tax accountant for tax planning, tax preparation, and tips and tricks to lower your tax liability and maximize your tax deductions. You typically go to your financial advisor to help manage your wealth, grow your portfolio, guide your investments for retirement, or plan for your children's education, bills, philanthropy, or other goals. Clients sometimes find it difficult or confusing to have multiple financial professionals in their lives. That's especially so when you get conflicting advice from them. Sometimes the duties and responsibilities of each are murky and they kind of overlap between the financial advisor and the accountant. A certain tax saving strategy recommended by a CPA may conflict with an investment strategy put into place by your investment advisor. You might owe a ton of money on your tax return from a single member LLC and ask your accountant, hey, it's April 14th, what can I do to dramatically lower your taxes? He might advise you to put $67,000 into your SEP, that's a simplified employee pension plan, or hey, that might knock 20 grand off your taxes, let's do that. And wow, that allows those funds to grow tax-free until you take them out. But your investment advisor may have already been in the process of setting you up with a solo 401k and a profit sharing component that the CPA didn't know about, and you can't do both. I tell you that story because that's something that happened to a client of ours, and that could have been easily avoided if the accountant and the financial advisor had worked together. It's up to the client, however, to you to make sure that the accountant and the advisor are on the same page. If you have a business with employees, that's especially important to have the accountant and the advisor working together. How can you do that? Easiest way, just have a three-way phone call with both on the phone and go through your top financial goals with your accountant and the CPA at the same time. And they'll both likely have ideas to implement, and that'll invariably be an investment decision or a tax decision, and investment decisions always have tax consequences. So it's best to hash those out. Make sure there's no conflicts in the strategy, no conflicts in the implementation. The first complaint I hear is, well, won't they bill me for my time? Yeah, so if your money's important to you, you want to make sure these things are done right. And I've seen hundreds, and I'm not kidding, hundreds of times where clients don't have an investment advisor and they do things like open a Roth IRA online without talking to a financial professional at all because what they saw on TikTok or Facebook told them, hey, go ahead and do this. Well, they do this without realizing that they made too much money to put it into a Roth directly. And I say that just because this happened to an extremely sharp attorney client of ours this year. He saw a thing on the internet, signed up with Vanguard, and set up a Roth IRA without talking to an investment advisor or his accountant. And then he had to take all that money right back out right before tax day and then pay the tax on the gains when we got all his tax stuff in. So check with somebody first. And I think part of the problem is that there's so much information out there online about money and investing and household cultures and influencers. The influencers make it sound so simple and so easy. But if you work with a financial planner or an investment advisor, you'll see that what they do is not so simple, though. You're not going to replace that kind of knowledge by reading some websites or watching some TikToks. It's just not going to happen. And we have joint clients with a lot of different investment advisors, of course. And one in particular, this advisor will come to our office every year, sit through all of his clients' tax meetings with us, and he does that to make sure that everyone's on the same page, that the investment strategies he's putting into place make sense with the tax strategies that we have into place, and then there's no surprises for the client. And we go through what the client's goals are and make sure they're met by both of us talking at the same time. And just a side note, there's a difference between a broker and an advisor. If you call a broker dealer, and you just want to buy a stock, their job is to sell it to you. Their job is to sell you something, and that's fine. If you have an investment advisor, though, they're acting in a fiduciary capacity to you. Their job is to put your interest first and foremost and make sure that your best interests, according to your investment objectives and risk tolerances, are taken care of and thought about. Your accountant's also a fiduciary. He's obliged or she's obliged to do what's in your financial best interest as well. An advisor focuses on wealth management, investment planning, asset allocation, while accountants are responsible for accounting, tax planning, and filing the tax returns. So it makes sense, and I highly recommend making sure that both of these trusted professionals are working together. Estate planning should really involve the accountant, the financial planner, and an attorney, if necessary, that specializes in estate planning. And by leveraging these professionals together, you can reduce the risk of something really bad happening. I worked on a case years ago where a very successful entrepreneur set up his estate himself. He used an online service and set up a will, and it was like 15 years ago, but I think it was $69 he paid. And that online will that he did not conform to the state laws where he lived. So that will was thrown out by the probate judge. The case was in court for years while his heirs battled over his $35 million estate. Both sides, I know for a fact, racked up hundreds of thousands of dollars in legal fees, accounting bills, and it was a painfully large estate tax bill. So altogether, many millions in expense that could have been completely avoided had financial professionals been brought in first. Yeah, you'll have to pay them a couple $1,000s, or you can pay millions of dollars in estate tax and some professional fees. So he could have put that accounts, like he had stock and bond accounts. If you wanted him to go to certain people, he could have put it in transfer on death, TOD accounts for the stocks and bonds. So those accounts went directly where they were supposed to go upon his passing. And it's a simple matter for a financial advisor to set up. An accountant could have advised him on maxing out his annual gifting limits to remove assets from the taxable estate over time prior to his death. And this guy was brilliant, but just because he was a genius in business didn't necessarily correlate that knowledge to understanding all the complexities of the tax code and how investment laws work. So if he had a good relationship with a CPA or financial advisor, they'd have both advised him, hey, bring in a qualified estate planning attorney, set up a trust or some other mechanisms to save your heirs millions of dollars in legal fees and taxes. Point of the story, don't be cheap when it comes to money. You pay an investment advisor and you pay your accountant and you get an outsized return on that investment. Outsized. You get back much more than you pay for those professionals when their efforts are coordinated around your goals. This is Brad with Premier Tax. Thanks.